Welcome to an interim FMD Investment Committee update. Today, I thought we'd come together a couple of weeks, well, probably 4 weeks in advance of when we'd normally come together for our quarterly updates, just because there's been a fair bit of headlines around economic activity and decline, and we've clearly also had some questions from our clients about the declines in their portfolios over recent weeks. As usual, I'm joined today by Richard Dahl, the chair of the FMD Investment Committee, and Michael Reynolds, a director and member of the FMD Investment Committee. Today, we thought we'd just do a short update, come back with our full quarterly update in a few weeks. But Richard, the question on people's lips is, there's been a lot of media, but why have portfolios dropped recently?
Lee, there's been a set of market conditions that we probably haven't seen for some 28 years, when we've seen all asset classes across portfolios come down at the same time. And we sort of wondered to ourselves, why has this happened? And look, this started to happen earlier this year with rise in what we call bond rates or long-term interest rates, where markets expect that cash rates, which have been an extraordinary accommodating lows for the last few years, are going to rise. That started earlier in the year, and then obviously exacerbated by what happened in Russia and Ukraine. But more recently, we've seen in June inflation numbers come out from the US, which have, if you like, really exacerbated what's happened to interest rates, bond rates, and all asset classes. When we get an increase in interest rates quickly, then we see a fall in valuation. So right across our spectrum of portfolios, from conservative through to high growth, we've seen a comeback in valuations, Lee.
So Richard, what we've experienced is this transition from artificially low interest rates to support economies through the COVID crisis, and now perhaps there's been a bit of some of the central banks have been caught on the hop a bit about the rate at which inflation has jumped, and we're seeing this switch now, and this asset readjustment is perhaps collateral damage in that reset. Longer term, there's some value in this reset, and it's a pretty important transition that we're going through, isn't it?
Central banks want to get away from the low interest rate environment they've provided for economies to be sustained during the pandemic period. And monetary policy is always one of those things that they use as a lever to either curb demand or increase demand. So lower interest rates mean people are happy, more confident to spend. And when they need to tighten the demand side in the economy, they raise interest rates, and people then are forced to curb their discretionary spending to cover higher mortgage costs and those sorts of things. So the central banks want to provide a mechanism that at a future point, if we have another really difficult period of time, they've got a lever available to cut interest rates again at a future point to try and stimulate the economy. Because when you've had negative interest rates in Europe for quite a number of years, those levers really don't exist anymore. The other big benefit, and although it's short-term painful for investors in fixed interest assets, we're now in an environment where income from those defensive assets is more meaningful than it has been for some time. 10-year bonds are back above 4% in Australia today, mid-threes in the US, and that means that defensive assets will actually provide meaningful returns to investors, which we haven't seen for some time. So, short-term painful, but longer-term a better, more balanced investment opportunity that we've had. And the low interest rates basically have forced equities to do the heavy lifting, and now going forward, fixed interest securities will actually be a more meaningful contributor to that part of the portfolio.
Perhaps we could just talk briefly about what the IC is doing at this point in terms of monitoring the situation and what it sees as next steps.
With interest rate securities last year, it was we reduced our exposure to that part of the market to try to head off some of this volatility, which has been more than probably everyone expected. And now we are looking at, if we look at the overall investment market set for all our portfolios, the one area that stands out is with higher yields on bonds coming through, is somewhat considering to reinstate that position we had before and have more meaningful income coming through from portfolios, particularly conservative, moderately conservative, and to a lesser extent balanced portfolios. And that's the first thing that's on our minds. The next thing is we're looking at obviously asset allocation across the board, with share markets being the greatest driver of returns. And there's still uncertainty as to how things play out economically, with interest rates, cash rates rising, also inflation costs, real inflation costs, energy costs, and so forth. So there's certainly parts of the market that are going to soften, and equity markets have fallen in advance of that. So equity markets already looking ahead. What we're trying to look through in setting our portfolio allocations is to say, when do we think that those falls will reflect what's going to happen in the greater economy? So at the moment, the asset allocations otherwise, we're holding as they currently are, Lee.
Mike, you said to me when we were preparing for this conversation that you thought that the central banks were hoping that their bark would work and their rhetoric would work, perhaps to moderate behaviours rather than necessarily the bite of many more significant interest rate rises. And I think that's a theme that, whilst we're not certain of, we think may well play out. Yeah, is that fair to say?
Well, I think, if you think about the person with an average mortgage here in Australia, if they have an expectation that their mortgage costs are going to move materially higher, that coupled with petrol prices, higher electricity costs, higher energy costs, shortage of food in groceries because of floods that we had in northern New South Wales during the summer period, all those things basically mean that consumers will stop their discretionary spending earlier. And that's exactly what central banks are wanting to achieve in just taking the heat out of the economy, when at the same time you've still got these supply chain challenges. So that's the bark worse than the bite, and I think that's a reasonably good chance of being a likely outcome.
Well, thank you both for your contributions today. We'll be back in about 4 weeks to do our end of financial year update. But I wanted to make sure we had an opportunity just to get this short message out today. So thank you very much for your contributions, and I look forward to seeing you next time.